Biani, heading business development and sales for Alpha Credit Advisors. Welcome to Alpha Credit Advisors, AAA Investor Connect. Friends, as we are navigating through a challenging market situation where the tariff war and global trade uncertainties are definitely causing some emotional reactions in the market. The uncertainty can often drive volatility, but as we all know, these kind of crises can also present great investment opportunities. The key is to balance optimism with caution, which is exactly what we were talking about from last few quarters. Be bullish, be prudent. Our emphasis on seeing crisis as an opportunity aligned with a long-term perspective, where rather than succumbing to short-term fears, investors who stay focused and make thoughtful decisions often end up benefiting. It's great that Mr. Rajesh Kothari will provide deeper insight into the situation. Having someone like Rajesh with expertise dive into the specifics of how such geopolitical events affect market will certainly help in making more informed decisions. With this, I would like to invite our founder and managing director, Mr. Rajesh Kothari. Welcome, Rajesh.
Thank you. Thank you, Sandeep. Good evening, friends. Good evening to all of you. I'm sure last, we all ask for correction, but whenever correction comes, I don't think anyone likes that correction. Valuation reasonable and talking about buying a reasonable valuation and actually implementing it at times, mentally, it takes a lot of courage for most of the investors. And, I think this volatility is becoming a new norm. As I was saying from last, I think 2-3 years, that world is becoming more VUCA, volatility, uncertainty, ambiguity, and complexity. And in last from 2020, from COVID times, this volatility is increasing every day. First, there was a COVID, then there was a supply chain problem, then there was a Russia-Ukraine war. Of course, there are elections, and now we have a Trump tariff. And when market goes down, probably whenever market goes down more than 4-5% globally, a lot of noise comes into play. But I think very important is to filter between the noise and the actuals, the narratives and the facts. Facts based on the data, facts based on the actual what is happening on the world economy. And at times, what is most important is not to just focus on what is announced, but also equally actually interpreting that how much it is priced in. And that's where the big difference between the noise and real implementation, the execution, whether to buy a particular stock or not, or from investor perspective, whether they should do top up or not in any asset class, that's what basically makes the difference. With that, let me quickly, talk about just in 2 minutes. I'm sure most of you are familiar with us. So I'm founder of Alpha Credit Advisors, and with me, of course, is joining Govind Agarwal, who has been also the part of the investment team, director investment team, and also with me is our head of sales, Sandeep Biani, who looks after the entire India sales and business development. I'm also very pleased to share with you that now we have 3 offices. Of course, our headquarters is based in Mumbai. Now we also have a branch office in Delhi, and also we have a branch office in Bangalore. In Mumbai, with Sandeep, we also have a head of Western region, which is Yuvraj, is also part of the Zoom team. And we also have, Rovind, who is looking after the North region. And with Rovind, we also have his colleague, Devanshu, who looks after Delhi and particular markets. So friends, this Alpha Credit Advisors, one of the few firms with 15 years of longevity. And in 15 years, we delivered almost close to 15 times to our investors, roughly 18-19% compounded annualized returns. Our USP is founder as a fund manager, no conflict of interest, longevity, which is very, very important. And last but not least, the award-winning track record. This volatility is not new to us. And that's why when we say the competence, that as a team, we bring 135 years of combined experience on the table. And as an individual, I have spent now more than, since 1994 into the market, so almost like 25 plus years of experience in fund management. Govind has 27 plus years of experience in fund management. And it is that competence which basically makes us to understand how to navigate the different times of the market. This is not the first time. We have seen 11 collapse, we have seen Y2K crisis, we have seen the NBFC crisis, we have seen the IL&FS crisis, we have seen the various governments, two versions of Donald Trump, two versions of Joe Biden, two versions of UPA, two versions of now NDA, and all these cycles basically experience that helps us to understand the cycles, not focusing on only what to do, but more importantly, it makes us to learn more and more about what not to do. With that, let me straight come to the today's topic, the US tariff and navigating this tariff uncertainty. I'm sure a lot of things is already published, but just in 1 minute, I'm sure everybody knows that tariffs are basically used to tax a particular goods. And Donald Trump basically, he announced various types of tariff, and one important first time kind of a history is the reciprocal duties on 60 nations. What is reciprocal tariffs? I'm sure all of you know by now that a reciprocal tariff is a trade duty imposed by a country in response to tariff levied by another country. And here he has worked out a particular formula, and based on that formula, various reciprocal tariffs were announced. But what is important for us is what happens because of these tariffs. And that's what is important. This raises the average effective tariff rates in United States to 25% from 5%. So effective tariff rate is highest levels in last 100 years. And of course, this is significantly higher than what everybody thought of in initial phase. We all thought, global economists, global strategists, including all of us, we all thought that it will be roughly about 10, 12%, but actual announcement at the effective rate is 25%. Little bit going into the details of this, and this one chart, which is very important. I talked about this chart even in our last webinar. The top 20 countries with the largest trade deficit. And look at this chart, the China and Vietnam. Of course, Mexico is next to US, and you know all about Mexico. European Union is a different thing altogether. The highest trade deficit is basically China, one of the important country, Mexico, and Vietnam. India is very, very small. So from the value of goods exported to US, if you look at this chart, this very important chart again, that we are at roughly $88 billion. China is almost $450 billion. That's huge, $450 billion. And Vietnam is also significantly higher than us, close to $140 billion. These numbers are very important to keep in mind, that what is happening in the minds of Donald Trump, that why he wants to reduce the trade deficit to zero, and why during COVID he learned that there is no economic security, because when the supply chain breaks, everything collapses, and ultimately economic security also becomes the country security. And therefore there's a trinity of not only the trade tariff, but trade tariff linked to the security of the nation, and that is further linked to the currency of the country. And that three things are basically stitched together while doing this trade war. If you look at these reciprocal tariffs, here is the list. And China, while the reciprocal tariffs are 34%, before that 20% was already announced. So the effective tariff on China is 54%. And if you look at here, Bangladesh is 37, Sri Lanka 44, Thailand 36, Vietnam 46, and India is at 26. India's position is relatively much better off than most other emerging markets, including China, Vietnam, Indonesia, Bangladesh, Sri Lanka, and we are only marginally behind developed countries like Japan and South Korea, which are at 24 and 25%. So the effect on India compared to the other economies, as far as on today basis at least, is much better compared to the world. Now, very important question, and there are a lot of debate which is going on, that whether tariffs cause inflation. And this is not the first time. This is a very interesting chart. I don't know if how many of you looked at this data point. But when we went through a lot of research on the US economy, because this is not the first time Donald Trump has announced this tariff, even in 2018. And one interesting item is the washing machine, on which there are numerous research papers were announced and publicized by global economists. Now, economists all agree by and large that cost of tariff is largely paid for by combination of consumer and companies. And for it means the companies, they have to accept the lower profit margin to sell their products. Normal estimate, 30 to 50% of the cost is passed on to the consumer, and balance is to be absorbed by the companies. If you look at 2018, in the first month, so this was the date on which tariff got announced on China on washing machine. And if you look at this from 2018 to 2019, most of this first 12 months, there is almost 12 to 15 to 18% increase in the entire CPI of washing machines. And why this is interesting chart? Because even the domestic manufacturer in US, they took benefit of significant increase in the import price. And even they were manufacturing domestically, they decided to increase the price of washing machine because they wanted to make actually more margins and more profits. In fact, there are many companies in the dryer segment. They also increase the prices of dryers, although tariff on dryers was not touched in the initial period. So in the first 12 months, at least, the consumers have to bear the brunt, and that, of course, gets impact the overall demand growth. Of course, after that, prices again came down because, as you all are aware, the China devaluation was huge, and to some extent, therefore, most of the price increase was again taken off. Post 2020, of course, it was the supply chain bottlenecks and many other reasons which led to increase in the washing machine prices. But the first 12 months, I'm just trying to basically give you some synopsis that what happened in the first 12 months. After 12 months, there might be many other reasons, demand, supply, currency, and so on and so forth. But at least in the first 12 months, there was a significant increase. Most of the increase in import duty was passed on to the consumers, and therefore the cost went up significantly high. This is more interesting chart, that how do tariffs affect the stock market. And on the, if you look at this shaded bar, shaded area, that is basically $1,000 investment in S&P 500. And if you look at this blue line, it is the annual inflation. And the pink dots, it talks about the tariff headlines. So the first Trump administered tariff in China that started the trade war. Volatility, of course, increased during 2018. Chinese economy went through the slowdown, and the trade war worry started. If you look at throughout 2018, S&P 500 declined by roughly 4.5%. However, in 2019, index recovered sharply by almost 31%. Consumer spending, by and large, remained steady. And if you look at very closely the blue line, the overall inflation was kind of a muted, ranging between 1.5% to 2.85%. Of course, there was an increase from 1.5 to 2.85, but it was not significant, because if you look at the opening point as well, it was hovering around 2.25, 2.5%. So this is the date, 22nd January 2018, where Trump announced tariff on solar panel and washing machine on China. By March, it was announced on steel and aluminum. By June, he ends tariff exemption for EU, Canada, and Mexico. By June and July, EU and Canada, they decided to retaliate. By September, he announced another phase of Chinese tariff. By month of May, again, China tariff was increased. And by August, everything was included in those goods. And in this entire journey, while in the initial phase, market was volatile, as you can see here, this is the first phase. But then market quickly recovered. By October 2018, actually it went higher than even January 2018. And then when the entire economy of China was hit by tariff, third phase, market again came down, and then it started moving up. And then despite another 2 rounds of tariff by US, market then started discounting it much earlier, and hence therefore no effect on the market. One important conclusion which I would like to draw from this line, this chart, is that in about 12 to 18 months, market actually gave a significantly higher returns. The first 6-8 months were painful, but after that market went up 31%. And the volatility and the downfall was only 4.4% in initial phase, but ultimately market went up 31%. So somebody, for example, who brought S&P 500 here without knowing what will happen, and all of a sudden Donald Trump came and he imposed duties on China, then he imposed duties on Canada, then he imposed duties on EU, then he imposed duty on Mexico, and then EU retaliated, Canada retaliated, China retaliated, everything happened. Of course, first he lost from $100, it declined to 96, but ultimately he decided to hold on for 24 months, and 100 became roughly 127. And that's what is important message to all of us, that at times volatility results into confusion in the mind that will it impact the long-term earnings growth, will it impact the long-term GDP growth, and so on and so forth. But ultimately, the earnings were resilient in the US economy, spending power was not impacted to that extent, and market recovered handsomely. And market recovered because earnings growth remained strong. So market is mirror of earnings growth. Net tariff implications for USA. As per global economists, the US GDP effect is 1.5 to 2%. It can be as high as 2.5% if everything gets implemented as per his announcement. And definitely that means there is a risk of recession. And earlier the probability was only 25%, but now the probability is even higher. Of course, this can be legally challenged, there can be negotiation, there can be subsector exclusion, and so on and so forth. And all that stuff leads to the uncertainty in the minds of the corporates, uncertainty in the minds of investors, and that means more volatility. So if the tariff gets implemented in terms of whatever is talked about to its fullest extent, then definitely there is a risk. However, the reality we will know only after 3, 6, 9 months. There is no point of doing speculation that what can be the various things which can be announced by Donald Trump to cushion this effect. But I'm sure he knows what he's doing. And I'm sure, therefore, just like during COVID times, when in March 2020, COVID entered India, everybody talked about only COVID because it was the first time experience for everyone in the world. But by June, the vaccine followed. And that's what happens. Market discounts the negative things first, but then there are various other things which comes up, which basically offset or mitigates the effect of the negativity. What about India? And as you can see on this chart, the top 15 items of India, which India exports to US. Number 1 is electrical machinery, equipments and parts. This also includes electronics, including mobile phone. This is the 2024 data, but 2025 mobile phone is going to be significant. So this 14 is going to go up maybe to 18 to 20. Next is pharmaceuticals. Next is precious stones. And then there is a machinery and mechanical appliances. And of course, then there are chemicals, and textile is roughly here 2.5, apparel and clothing accessories 2.4, and many other items. But important to focus on these top 5-7 items for our country. Now, this is something we have prepared in depth, and this is very, very important for all of you to understand that how India is positioned compared to other countries in the world. And here I have plotted India and China, and also Germany, Ireland, Japan, Korea, Taiwan, and Vietnam. The green color means tariff is higher than India, and dark pink color means tariffs are lower than India. If you look at this slide very closely, the electrical machinery, roughly $14 billion is what US imports from India. If you look at China, is $127 billion. If you look at the second very important category, machinery and mechanical appliances, India is $7 billion, China is $85 billion. If you look at textiles, India is $8 billion, China is $27 billion, and very importantly, Vietnam is $16 billion. So 26, 27 plus 16, roughly 45, 47% in textile. And similarly, if you do machinery, 85 plus 30, $115 billion. So we are too small. And that also means the scope of improvement in market share if we take the right steps as a country. And it also means the lesser effect on India, which I'll talk about later on. But this is a very important chart from the competitiveness perspective, that if we take the right steps, be it electronics or be it textile, where we already have a very strong domestic strength in terms of the raw material in case of textile, in terms of the labor, in terms of textile, in terms of organic chemical, we have a right chemistry domain. So there are areas where there is a possibility of significant improvement in market share. There are two conclusions for this slide. Number one, the tariffs on other countries are much higher than India. Number two, India market share is significantly lower compared to the competitors, in particular China and Vietnam. So where India stands, if you look at the pharma, this is one category which is right now exempted, but as Donald Trump said that tariff on pharma will also come soon, very soon. Let's assume that happens. Please keep in mind, the pharma is not only about India. Pharma is also about the innovative drugs of Germany, EU, particularly the entire EU, because that's where there is a significant expensive price drugs which are available in US because they get imported from Germany and Ireland. That's huge. So when you talk about pharma, please keep in mind, it is not only about generics, more than generics, because generics is only $12 billion. More than generics, it is about the innovative products of Germany and Ireland. And if they face the higher tariffs, the price gap between the innovative drugs and the generics will widen further. And if that gets widened further, it means generics becomes much more attractive from consumer perspective, number one. Number two, when it comes to the pharma, on the generic side, there is a huge, I would say, price war, which has happened for almost 10 years in US. And many companies, they are now out of business because they started making losses. And therefore, the competition right now is not so high compared to what it used to be about 5 to 10 years back. And hence, I believe that in case of the India, where there is a tariff in case gets levied, most of the tariff will be passed on to the buyers. Then, of course, the buyer is to decide, the customer is to decide whether they want to finally pass on to the end consumer or not. But as far as Indian companies goes, I believe that most of it will be passed on to the customer of US. In terms of the textile, if you look at the India market share in knitted and woven textile, it is roughly about 7% compared to China, Vietnam, Bangladesh put together at 50%, 50. Without considering yesterday night announcement of Donald Trump putting additional tariff of 50% on China, without considering that as well, as you can see here, where I talked about China is right now 54, and Vietnam is 46, and Bangladesh is 37, compared to India, which is 26. So India is significantly lower, and therefore, while there is a possibility in the initial first 6-9 months, there can be pressure on the corporate India, because they also might have to absorb some of the cost increase. But in the long term, this can be significantly structural benefit to our country, India, to gain the market share. Initially, first 3, 6, 9 months, it may not be so easy to pass on the full cost increase, and some part we might have to bear. But the good thing is that China and Vietnam and Bangladesh, those tariffs are going to be exceptionally high. And therefore, to that extent, Indian suppliers, there were some, I would say, at least better negotiating power to make sure that effect is as low as possible on profitability. On electronics, our share in electronics is less than 5% as compared to China 30%. The good thing is that government here has already decided to incentivize through PLI and various other such measures. There are favorable tailwinds. The largest electronics company, USA, Apple company, that Apple is taking a lot of steps to make sure that there is the right supply chain. Government is working very closely, and therefore there is a high chances of electronics exports going up significantly from current level over next 2 to 3 to 5 years. You can imagine what will be the Apple retail price in US if they keep buying it from China with a 54% tariff. I'm not adding another 50%, which is announced by Donald Trump yesterday. Even at 54%, it becomes a very, very difficult to pass on that kind of a cost increase to the end consumer. And therefore, it is in the interest of US companies to further take the sourcing from countries like India. The good part about these 3 sectors, why I selected only 3 sectors and why I have not selected, for example, the engineering, is because in these 3 sectors, India has taken several steps to improve its competitiveness. In pharma, India has proven itself. It is now the pharmacy medical store for the world. During COVID, we have proved again that we are resilient and we are one of the best in terms of not only cost, but also the quality. Similar for textile, India is known for the best of the quality as well as cost competitiveness when it talks about textile. And third is electronics. Thanks to Government of India last 5 years efforts of making India and PLI, there are companies which have quadrupled their revenue, 10 times they have become in terms of revenue size, and they are geared up to make the further investments for next 4 to 5 years. These 3 sectors, I believe, is our strength to improve our market share. Even if India is to reduce the tariffs on US imports on few categories, I believe it will not be significantly damaging corporate India, because most of those goods anyway India is importing, and our competitiveness in terms of the purchasing power is anyway not so high, and therefore the impact is likely to be very, very limited, except maybe the automobiles, where entry of Tesla, and in case if they launch the low price model in India, that can of course give tough competition to existing automobile companies, whether it is Maruti, Mahindra or Tata Motors. But otherwise, most of the listed companies and also overall corporate India, these 3 sectors, I believe, will be the net beneficiary of relative better competitiveness due to tariffs and also due to the US policy against China. One more good tailwind for country like India, which is import dependent in many commodities, because of the global slowdown in the recession or fear of recession, there's a lot of commodities prices have already started coming down. The crude we have already seen the crude coming down, and that's true for even many other commodities. India being the net importer definitely benefits out of this, and therefore to that extent, the inflation will continue to remain under control, and that can also have a positive effect because the RBI will get more scope in terms of reducing the interest rates. Tariff implications for India. As you all are aware, India is a domestic oriented economy. with consumption accounting for almost 60% of the GDP. Merchandise exports account for only 12% of GDP in FY24. So even if one assumes 10% decline in value of India's exports to the US, the total impact on India's GDP growth is likely to be very, very minimal. Of course, one more sector which can be indirectly get adversely impacted is the software, because India exports in terms of service exports are huge. So recession in USA can adversely impact our service exports, and therefore to that extent, the ultimate cascading effect on overall economy. But there is also an opportunity for India's exports to gain market share from other Southeast Asian countries, in which case these tariffs could be marginally positive for India. The sectors in the initial round, which looks to be impacted, which is electronics, precious stones, auto components, and machinery, and of course the garments. Also, we need to keep in mind that there are sectors where a high concentration of SMEs, and therefore employment can be also at risk, and therefore there is a possibility of government support to these sectors. So we hope that government also take the right steps to support the MSME of India, which are we have a high concentration of their business in auto components, garments, and also the precious stones. The companies which are part of these sectors, we need to monitor them very closely. They may get impacted in the short term because export turnover may come down, because the global world trade may come down, but they might have to reduce the prices to compensate for this kind of a tariff, maybe part of it. We also need to make sure that what are the bank's exposure to various sectors to make sure that it doesn't become a credit cost issue for Indian banking system. So we need to also monitor the sectoral exposure of the banks. In terms of the equity market, if you look at the Nifty, and if you look at the profit contribution of Nifty, about 22% of the profit that is at the risk due to USA tariff policy uncertainty. So IT is 13% of Nifty profit, Pharma is 3%, Metal is 3%, and Tata Motor is 3%. Pharma, most of it is going to be passed through. So within that, this is at the low risk. IT will be impacted because of the second effect. As the US IT spending comes down, then definitely revenue growth can get impacted. So there is no direct impact, but there is a secondary impact. Tata Motor, of course, gets impacted because it's a direct impact. Metals, if the prices comes down, has any impact. So roughly 20% of the profit pool is the risk. Let's assume that 20%, therefore, the growth becomes very, very low, or it can become a zero growth, for example, because in IT, it will not be a degrowth, it will be like a flattish growth because of the recession effect. Then also the Nifty earnings growth, which was expected around 13 to 15% for FY25, I mean, for the coming year, FY26, still it will not be that big dent because it may get impacted by 2% or 2.5%. Still it will be reasonable, around 10 to 11%, which is not bad considering the entire world is going through such challenges. The most important question is, as an investor, what should we do? And last time also on 20th of February, when Nifty touched 22,000, we came out with this presentation and we had a detailed webinar talking about this. This is not the first time we are seeing the uncertainty related correction. In fact, the COVID was the worst because COVID was God created disease and not human being created disease. And if you go back to that memory lane, you know, one of my investors actually called me up and he said, should we buy today or should we buy after 3 months? Or should we buy after 12 months? And I said, let's go back because important is to go back to the data. And let's assume that you are in the COVID period. And during COVID period, when the first 14% correction happened, that is Nifty was 9,500. And you said that, let me invest. If you had invested in 9,500, within a matter of 10 days, index became 7,500. But what is more important is that by July, you actually, Nifty became 11,500 by July. From 9,500 to 11,500, you got 20% returns in 3 months. Of course, in between, there is a paper loss because 9,500 became 7,500. So sometimes, why market became 7,500? Because at that time, there was no visibility of vaccine. At that time, it was a fear that entire human being existence is the risk. In fact, if you look at the market went down 32%. The hospitalization happened in the month of June and July and August. The casualty happened in July and August. But that time market never came down. So market is always forward looking. It is never a rear view mirror driving. When market comes down, it discounts various negatives. And that's why it went down first. But if you are willing to hold, if you are willing to take a little bit longer term view, 2 years, 3 years, 4 years, 5 years, if you take a little bit longer term view, one might look stupid, one will forget, even if you are holding till March 2025, in matter of 3 months, Nifty went up 20% from that price. So nobody knows what will be the market doing tomorrow. But if one has a long-term view, normally market discounts the negatives quickly and impactfully. Same thing happened during Russia-Ukraine war. It got announced on 18th February 2022. It was a much bigger event in my view because it was a third world war kind of a news headlines. Within 90 days, market corrected 14%. 14% within 90 days. And then if you look at it, it recovered the entire loss in the 6 months. So whether there is an impact on the world GDP growth based on yesterday's announcement as on today, answer is yes. But do we know what will be the next steps Donald Trump might be announcing to mitigate this effect? We don't know. Whether he will do something, any smart person would have the number of things to counter any news, good or bad, correct? And therefore, I believe that, I don't want to speculate, but I'm sure he would have as a president because he has announced this tariff. He will be knowing what are the remedies. Can it be tax cut? Can it be various other measures? I'm sure the governments, the bureaucrats, the banking system in the globally, they all are proactive enough to make sure that it doesn't enter into the global crisis, be it kind of a financial crisis or be it even otherwise crisis. So I'm fairly positive on the market. If you ask my personal view, while volatility will remain high, but if one is a 3, 4, 5 years view, is a good entry point from the overall valuation perspective. And I'll briefly talk about it in a moment. If we look at the Nifty valuation, we are at 10 years PE. In fact, with this correction, we are a little bit further lesser than 10-year PE, about 5% lower than 10-year average valuation. After a very long time, even on price to book basis, we are almost like 10 years average basis. And it means that the entry point is in your favor. The margin of safety is in your favor. The valuations are comfortable. I again repeat, that doesn't mean that market will not go down tomorrow. Markets are volatile and one needs to have a little bit longer term view in terms of the time horizon. If one is a little bit longer term view, 3 to 4 to 5 years, can one expect the GDP growth kind of returns? I think so possible. That's what markets are in the long term. As a Nifty has delivered 12% growth, which is in line with the GDP growth of the country for last 10 years. What should be the investing playbook? First, as a global investor, India is a unique opportunity. India is an opportunity to take advantage to improve its market share. Its dependence on US exports is a natural advantage. And absolutely at the same time, the lower tariff compared to China and Vietnam is a unique opportunity. Nifty earnings to be significantly lesser impacted because only 20 to 25% of earnings are linked to global economy. But otherwise, the impact is going to be much lesser because Nifty is more domestic. At a portfolio levels, the multiple defenders one needs to cushion the portfolio from any shocks. As you are aware, both of our strategies, AAA IOP as well as triple budding beast, we have 50 stocks portfolio, and it offers the natural cushion in such kind of a shocks, and that has been the regular thing, and I'll talk about it in a moment. Domestic driven sectors to perform much better. So banking and finance, healthcare, hospitals, consumer will do much better. Globally linked businesses, there is a possibility of second level effect, as I talked about, particularly for IT, and of course, to a certain extent, metal and textile. But what is most critical is the fourth point, that active management is the need of the game to separate winners and losers. Companies and sectors will be impacted unevenly. There are companies which are domestic focused. There are companies which are service focused. There are companies which have a high pricing power. They will do much better. The companies which have a large profit size, they will do much better. Companies which have a debt-free balance sheet, they will do much better. Companies which have a multiple businesses, companies which have multiple customers, and companies which have multiple geographies, they are best positioned to make sure that they not only take this opportunity, but also in terms of the decline in the profit, so the impact on profit will be very, very limited. Coming to Alpha Accurate Advisors, and I mentioned that fourth point, very, very important, the active management to separate winners and losers. And I just thought to share one important chart with all of you, that how agile we are in terms of managing our clients' portfolio money. And if you look at this is the last 5 years chart, and I've also added April 2025, that is a current month as I speak with you. If you look at here, automobile, COVID wave 2 started, auto stocks were at the bottom. We took that as an opportunity. Auto index went up significantly high. And in March 2024, we started booking some profit after index going up almost 74%. In March 2025 and in the beginning of April, the tariff war got more intense, and therefore we decided to further reduce our auto exposure, which is currently at 5%. In capital goods, we were one of the early in identifying the capital goods as a theme. We started buying around 9 to 10% in March 2021. You can see how the index performs, 92%, 30%, 25%, almost 77%. When index went up 77%, we booked our profit. From 13%, we reduced to 9%. And then further, we reduced to 7% in last 2.5, 3 months. Healthcare is one of the sector which we loved during COVID time. And post-COVID, when stocks went up 75% in a matter of 4, 5, 6 months, we almost made it zero. And in the last 12 months, we started again increasing our allocation. Currently, we are at 9 to 11%. And as you can see that when we identify this pharma in last 12, 18 months. Yeah, so basically, what I was saying is that, the agility is something, very, very critical. And, while Sandeep will put up that slide in a moment, the moral of the story is that at different points of time, we kept changing the sectoral exposure depending upon how we looked at the earnings growth. And very, very importantly, also looking at what valuations we are buying that growth. And that is something, very, very critical. Like, for example, capital goods, we were the early identifier in 2021. And that time, the valuations were really very, very attractive, and implied earnings growth was almost like, 0% earnings growth. But in next 2, 3, 4 years, when the earnings became significantly, of course, earnings growth followed, order book followed, and the valuation also became extremely expensive. And that's where we decided to basically reduce our capital goods exposure, and you see the effect, because of that. So that's about, agility and active investment approach. If you go through the next slide, which is about, portfolio specific. This is a AAA IOP, which is our flagship PMS plan. As you are aware, this is a multi-cap portfolio spread across 50 stocks, across 15 to 17 sectors. And as you can see here very carefully, like, for example, chemicals, just one example I wanted to give you, like we increased the exposure. This was the one sector which we loved in 2018, 2019. We were almost having close to, 9% of the portfolio. entire sector went up through the best of the times. By March 2023, Chinese economy was opening up, and that's time we decided to exit the entire specialty chemical. We exited the entire specialty chemical, and in, I would say, last 6 months back, starting from June onwards, we started again buying same specialty chemicals. So very, very important is identifying the companies and at right time monitoring the business cycles, and of course, very, very importantly, exiting at. Similarly, if you look at the banking and finance, we increase our weightage from 25% to 31%. In consumer, we were holding very high portfolio exposure, roughly 15%. From September 2024, we decided to reduce the consumer. Within consumer, there are two parts, FMCG and discretionary. We understood that FMCG is going to be under significant pressure because of the demand issue. So we made FMCG almost zero, and our entire exposure is towards the discretionary. Pharma, I already talked about. Power, software. Software is also one thing, where we increased the exposure during COVID time, as I explained in my previous slide. And then, again, we reduce our exposure to take benefit when Russia declared war against Ukraine. That's the time we reduce our exposure to in software to almost like 6% or so. And then we started again building up in September 2024. Because of the US uncertainty in the recent times, we reduce again our software exposure to about 9%. So what I'm trying to say is that the agility is something very, very critical, and making sure that we monitor the business cycle, we monitor the earnings growth, and we monitor the valuation. This is the need of the day because markets are extremely volatile. So we need to take the right steps at the right time to make sure that we are always on the best of the portfolio is aligned to the growth. Sandeep, you can stop sharing. Mine is started. Give me 1 minute. So that is as far as IOP portfolio goes. Let me quickly talk about how our. Just a minute. Give me 1 moment so that I can take you to the right slide. In terms of the budding beast also, same thing. We have been active and agile in budding beast as well. Like for example, chemicals here also we increased to almost 5%. Consumer we reduced to roughly 4.5%. Pharmaceutical we are holding from 9%. We increase the weightage to almost 14%. This is as far as budding beast goes. Now, most important thing, how our portfolio is positioned from the current vulnerability test perspective, and this is something very, very critical. Friends, AAA IOP portfolio we have divided in 4 buckets: the low effect, the medium impact, high impact, and very high impact. If any portfolio company where the exposure to USA as a percentage of the revenue is 0 to 25% is under the low bucket, 26 to 50% is under the medium bucket, 51 to 75% is under high bucket, and 75% plus is very high bucket. And if you look at here, the percent of the portfolio, the low effect is almost 88% of the portfolio. And here it is primarily automobile, banking, finance, consumer, cement, and domestic pharmaceutical companies, most of it. 8% is medium. In this, it includes software and chemical companies like, for example, Navin Fluorine. Although I don't think in companies like Navin Fluorine, there will be significant impact because they are significantly, I would say, one of the best competitive with the best of the product and best of the cost. Also, they have one of the very large contract with Honeywell, where I see the limited, very, very limited impact. But still, let's keep fingers crossed. It is too early to talk about it, and therefore we are classified as a medium impact. And of course, there are 1 or 2 software companies where the US exports are very, very high, which is roughly 3.5%. We hold 1 textile name where impact is where our exposure is less than 1%. So overall, almost 88% of the portfolio is low effect, and 8% is medium impact. High and very high is below 5% of the portfolio. In terms of the sectoral allocation, if you look at here very closely, the banking is right now 31%. Within banking, we own corporate banks. like ICICI Bank has been our top holding from last 5 years. We have also increased our weightage in HDFC Bank. In NBFC, we like Bajaj Finance and Chola. We have been early identifier of the #1 gold finance company called Muthoot, and also we own Shriram Transport. In pharma, we hold CDMO companies. We have been very bullish on CDMO from last 3-4 years. We also have a few domestic pharma companies and very limited exposure to the companies who have a US business. We have a zero exposure to companies which have most of the business coming out of US. We have a zero exposure to them. Software is roughly 8%, 9%. In consumer, we own discretionary, no exposure to FMCG currently. Most of it is discretionary. In capital goods, we own companies where technology has a moat. So we do not own any companies which are into EPC and irrigation, zero exposure to such companies. All these companies are product companies. Automobile, roughly 5%, telecom 5%, chemicals, roughly 3.5%. And then there are others, roughly 9%. Power is, of course, 2%. And we hold 9% cash in the portfolio. One very important slide, which I always talk about during all my presentations. AAA IOP is a true multi-cap with average weighted market cap of roughly 4 lakh crores, 50% large cap and 50% mid and small cap. This data is as on 31st March. The previous slide is as on yesterday. The one I was shown here was as on yesterday. The one what I'm showing here is as on 31st March. So cash currently is 9%. As on 31st, it was 5%. But important to note is most of my portfolio companies, they are large by profit size. Almost 2/3 of my portfolio companies have 500 crores plus reported net profit after tax. Most of them are debt-free or debt equity less than 1. This is very important. If you closely, if you heard me, I've said that companies which are large profit size, companies which are debt-free, they are best positioned to weather any downturn, whether it's a global economy or local economy. Companies which are market leaders with a pricing power, they'll be the least impacted in any kind of economic cycles. Our portfolio companies have very strong ROE, 20%, and they have a very strong earnings growth of 25% for the next year. Even during first 9 months, particularly first quarter, second quarter, and third quarter, when the Indian economy was going through the slowdown, our portfolio is reported 19% revenue growth and 31% profit growth compared to Nifty revenue growth of just 6% and profit growth of only 5%. And that means it shows that what kind of stocks we own, the companies what we own, the resilient businesses, gaining market share, benefiting from expansion, and with the right balance sheet. I think very important for any fund manager, the drawdown. That's an acid test for any fund manager. Bull market में तो everybody does well, लेकिन bear market में पता चलता है कि fund manager कितना अच्छा है या कितना बुरा है. And if you look at this slide very closely, from 52-week high to 20th of February, the average BSE 500 stock is down 35%. BSE 500 index level, index is down 19%. And against that drastic fall, our fall has been much lesser at 18.1%. If you look at even from 27 September to 28th of February, against index decline of 18.7% and against average constitution average decline of 24%, our fall has been restricted to 18%. That shows the resilience and that shows the kind of companies what we own in our clients' portfolio. This is not the first time AAA is doing well in the bad times. In most of the times, 16 out of 18 volatile period in last 14 plus years, the blue bar, which is a BSE, which is a AAA IOP PMS, has outperformed the gray bar, which is BSE 500 index. Even during COVID times, our fall was lesser. Even during Russia-Ukraine war time, our fall was lesser. Even during the January correction, our fall was lesser. This lesser drawdown is due to the right stock selection, disciplined exit strategy, and 50 stocks diversified, adequately diversified portfolio. These are the 3 reasons why AAA has done better in the bad times of the market. In terms of the 1 year, 2 year, 3 year, 5 year, 10 years, and 15 years returns, the performance in front of you. Last 1 year, market has been going through various phases, volatile phases, election times, and of course, last 3 months because of the Donald Trump related uncertainty. If you look at the 1 year market returns, have been low single digits, 6-7%. Against that, AAA IOP has delivered healthy returns of 12.9%. In last 15 years, AAA IOP has delivered 18.3% consistently compounded annualized returns compared to benchmark returns of 12.6%. Risk analytics, our beta is less than 1. Sharp ratio is very strong. Standard deviation is also lesser. For any large family office, what matters is the rolling returns. And as you can see here, AAA IOP has delivered consistently superior rolling returns compared to benchmark. AAA AIF is also a multi-cap fund, category 3, open-ended, no lock-in period. And this is a performance in front of you. The 1 year 12.4%, and since inception 20.6%. The fund was launched on 16th May 2023. Coming to AAA budding based, the vulnerability of the portfolio, just like how I explained in IOP. In budding based also, 86% of the portfolio has a very low exposure to US between 0 to 25%. This includes automobile, banking, consumer, cement, engineering, and pharma. 10% of the portfolio has a medium exposure between 26 to 50%. This includes primarily software and chemical. And 4% of the portfolio has a high exposure to USA, 51 to 75%. So in nutshell, medium and high is roughly 14% and low is 86%. In terms of the current sectoral exposure, capital goods is 18%. Again, here we own many domestic companies which are product related businesses. There are some EMS companies, which is also part of 3.5% here. So 18 and 3.5, please read it together. Banking, we are roughly 15%. Pharma is 14%. Most of it is CDMO, hospitals, and domestic pharma. Consumer is 9%. Most of it is discretionary in nature, except one company which is into FMCG. Automobile and auto ancillary is roughly 10%. Chemical is roughly 6%. Software is 6%. Agri input is 3%. And others is 13.2%. AAA budding beast is probably, I keep saying, it's a mid and small cap PMS, but not a single small company by revenue and by profit size in our portfolio. Average weighted market cap is roughly 30,000 crores. And if you look at the profit size of most of these companies, is 100 crores plus. Most of them are either debt free or they have debt equity less than 1, under leveraged balance sheet. They all are market leaders with a ROE of 16.5%, and we expect them to deliver healthy earnings growth of 30% plus compared to Nifty earnings growth of 13%. Even in third quarter, AAA budding business delivered 20% plus revenue growth and 20% plus net profit growth compared to Nifty revenue growth of 6% and profit growth of 5%. Drawdown, like in IOP, AAA budding beast also. If you look at 52-week high to 28th of February, the average BSE 400 mid and small cap stock is down 37%. Against that, AAA budding beast fall is 23%. If you look at from 27 September to 28th of February, our fall is restricted to 22.1% compared to index fall of 23.2%. In terms of the performance, last 1 year, against BSE 500 6% and BSE 400 7.5%, AAA budding beast delivered healthy returns of 16.4%. And since inception, it has delivered 26.1% compounded annualized returns to the investors. Risk analytics, beta is less than 1. Standard deviation is 15.27 with a very strong Sharpe ratio against BSE 500. Although it is mid and small cap, the beta is even less than BSE 500. And that talks about the right stock selection and the disciplined exit strategy. With that, I would like to thank every participant for hearing us very, very patiently. And just to conclude, markets are likely to remain volatile, but generally in the history, the point of uncertainty also becomes point of opportunity. The maximum point of uncertainty creates opportunity to deliver the maximum returns for the investors. So I believe that this is a time to avoid the noise. This is a time to focus on fundamentals. Indian economy is going to be much lesser impacted compared to the many other countries in the on the map of world. Our reciprocal tariffs are also much lesser compared to any other of our neighbors, and that gives unique opportunity to our country. At a portfolio level, we need to be into the right stocks. We need to make sure that we have right agility, and we need to make sure we have right active investment management. We don't need to be into the momentum. We need to make sure that we remain focused on fundamentally sound companies, buy at the best of the growth, monitor the business cycles, buy at the reasonable valuations, and make sure that we try to exit at the best of the possible time. With that, I would like to thank everyone again. And with that, we can open up for question and answer. Thank you. Sandeep, you can take questions.
Yeah.
Thank you.
Yeah. Thanks, Rajesh. Participant requesting all, please post your questions in the Q&A section. I'm repeating, please post your questions in Q&A sections. We'll take one by one. There is one question from Profit Tantra. Sir, thank you for the wonderful presentation. Queries, we have exposure to some value fashion stocks like V2 Retail. Even though results are good, we have reduced the exposure at right time and have also increased cash levels. Just to understand, how do we decide as a fund house when to increase the exposure to any existing stock? The reason I ask this is even though results are coming good in few stocks, we have reduced the exposure. Please share your insights.
Thanks for this question. I think what is very, very important is to, there are 2-3 things which is important whenever we take the exit calls. First, what is our portfolio exposure? If exposure increases because of the stock price goes up significantly, we do trim. Number 1. Number 2, what is already valuations are discounting what kind of growth? That's very important. If valuations are already discounting the best of the growth for next 2-3 years, then it means the upside is going to be very, very limited. And the third important factor is how do we see the market in general and how do we see the risk reward opportunity? If the risk reward opportunity in stock A is better than stock B, then I need to exit or reduce my portfolio from company A to company B. So the company which you are talking about, I think that company is doing extremely well. We have identified that stock at the right time. We made almost, I would say, 30, 40, 50, 60% returns in less than 6 months. And therefore, we thought to reduce. We have not exited. We still like that business. But there are many other opportunities which are also available at an attractive valuation. So as a prudent investment manager, we keep doing this balancing and checking what is available at what valuations. And therefore, we took that call of little bit reducing our exposure in that particular company. I hope that answers your question.
Thanks, Rajesh. Next question is from Mr. Sanjay, I think. In such times where the market are driven more by the news flow rather than fundamentals, how does retail investors pacify themselves through the volatility? Should they stay sidelines till some clarity emerges, or should they stay invested?
See, I think once retail investor has trusted you as a wealth partner and or trusted us, or for that matter, any other investment manager, the best is to leave it to them. Markets are not volatile for the first time. And that's where very important is the competence and the longevity comes into play. If the fund manager has seen such multiple business cycle from last not 5 years, but 10 years, 15 years, 20 years, 30 years, it is like you are driving a car, but it's not first time you are driving the car. And you know exactly where signals may hit you. You know where speed breakers can hit you. You know where pothole kabhi aayega, khadda kabhi aayega, wo bhi agar you know कि kabhi bhi aa sakta hai. पहले पूछ के तो आएगा नहीं, कभी भी आ सकता है. But if the driver is good, car is good, the engine is good, and seatbelt is on, that's a discipline. If these 3 things are right, so your vehicle, car is an equity asset class. You know that is the best vehicle, to reach. If you want to go from Bombay to Pune, you cannot go by a cycle. You need to drive car, and the car means that's the equity. So road is India GDP growth, correct? You need to take the highway, and that's the best option. I need to take the car rather than bicycle. That's a second best option. And then you are selecting the right manager who has experience of navigating the different signal, portal, whatever it comes, he has to navigate right way. And of course, he must be having the right engine. The car must be of the good engine. That's something very, very critical. That's equity as an asset class offers you. If these three things are right, volatility तो होता ही है, volatility कभी नहीं है बाजार में. Every day there is some volatility. But a right manager is the one who optimizes on this volatility rather than creep on the volatility. Volatility, take it to you as a friend. If you can optimize it, that's the best thing what you can do. Whenever market goes down, normally 10%, 15% kind of a bad days, that's actually good time to keep adding up, keep doing top up. Have a 3, 4, 5, 7 years view. India is at a different growth juncture. We have a number of opportunities. At a country, we are taking all the right possible steps. Look at, for example, exports of mobile. 5 years back, it was zero. Today, look at our electronics exports. It is making the new records. And I think for next 5 years, this will completely change. Now, when one Apple comes to India, it's just not one Apple, but the entire ecosystem that follows. And when the entire ecosystem follows, the kind of employment opportunity it creates, the kind of the vendors opportunity it creates, the kind of SME opportunity it creates, is a cascading impact. It's a multiple effect. So I think we should not get too much disturbed by this short-term volatility. As a manager, as a fund manager, we are doing our best to make sure that how can we protect capital and create wealth. And that's get reflected in our less drawdown as well. But have a longer term view, 3, 4, 5 years view. And I'm sure equity as an asset class for a country like India, where GDP growth is the fastest growing economy in the world, I think you will not be disappointed by investing into this asset class.
Thanks, Sir Rajesh. The next question is, what is your view on mid and small cap valuation at the moment?
Well, I think mid and small cap is a very pretty big, large space. And in this space, if you ask me the top 400, 500 companies, those are the best position companies. So if you ask me the tail end of total 5,000 listed companies, so if you remove the last 2,000 stocks where the fraud happened in last 18, 24 months, many stocks went up 3 times, 4 times, 10 times, 20 times, which I don't think is fundamentally justified. So we always focus on the top 500, 700 stocks, correct? And if you ask me, within that, one need to do the cherry picking. Mid and small cap is all about the cherry picking. And if one does it in a right way, then there is enough opportunity to create wealth. But of course, one needs to be a little bit long term. Yes, the valuations are a little bit expensive compared to what it used to be. But if you look at the growth, is also higher. If you look at the debt equity of mid and small cap companies, good companies, they become zero. Earlier, they were 2 times leverage. Right now, they were zero leverage. So the companies with 100 crores plus profit, they are no more mid and small, but they get tagged as a mid and small. So if you look at, for example, our budding based, actually, we do not have any company which is a small company by revenue size or profit size. So out of 5,000 listed companies in India, there are only 800 companies which makes 100 crores plus profit after tax. Only 800 companies. But as per the classification, only top 100 by market cap is called large cap. It means 700 companies out of 800 is called mid and small cap. So the largest luggage player is a small cap. Second largest luggage player is also a small cap. The largest plywood player is a mid cap. Largest capital goods company, one of the multinational company, is a mid cap. The largest logistic company with a 20% return on capital employed is a small cap. Largest mall of the country is a mid cap. But these companies are not small. These companies are not mid. These companies are large. But their market cap is not top 100 by market cap. So as a manager, we focus on these businesses which are large by revenue size, large by profit size, but they might be tagged as a mid and small cap. I think one should not worry too much about that if one is a 5 years view, because growth is strong. The balance sheet has improved a lot, and one needs to do cherry picking within this segment to create the long-term alpha for the investors.
Thanks. The next question. Thanks for all the facts. Small question. In first term of Trump, tariff was product specific. Now it is much broad based. Would there be any chance of stagflation at global level? Nevertheless, India could get marginally benefited. I believe, Govind sir, let's take this question from the US itself.
Yeah, sure. So, yes, Rajesh has explained the impact of tariff and the relative advantage India has or relative to many other emerging countries. In fact, if we analyze, in the current global scenario, we are a very, very well integrated global economy. It is extremely difficult for any country to move away suddenly from this and start own manufacturing in isolation, which Mr. Trump is also talking about. These could be the tariffs and other moves by the government in US could be ways to negotiate the benefits for the country, which we do not know as of now. So yes, it is getting impacted as of now, but there could be many other things which are there with the US government and which we do not know. And as I just mentioned, we are the integrated economy, and suddenly if you start importing goods from say China or other countries, or at double the cost, the impact on the local economy is very, very high. And we also know that any political leader or any government, do not want their respective economies to go down and be into the recession, because they know that the next term they will not get elected. So from these perspectives, I think these seems to be very short-term measures. Some remedial measures will come up. Again, we do not know. As Rajesh mentioned, the uncertainty continues. And during this uncertainty, we have to take the advantage. Let me also give you, some takeaway from one seminar. Actually, I'm in US and I attended one seminar on, is how much Doge can save money to the taxpayers in US. And there were three experts, very, very senior experts. And Doge, if you see in their website, has published that $140 billion of saving has already happened to the US taxpayers, translating into almost $900 per citizen. The experts there say that they do not believe in this, and they're all very, very senior. It's a think tank which organized this. And they said that there's a proper process of law which is there under the Constitution, and the Congress has the authority. If anything has been allocated to any particular agency, then it has to pass through the proper process of law. The executive cannot do it. That was one key observation. Second thing is, one gentleman dissected the, various items which are there in that website, and say that one item suggested $3 billion of savings for the government. And with the proper numbers which are there on the website, he said it is actual saving is $128 million. It's not $3 billion which the website is claiming. So, there are too many, I would say, variables which are there. What is appearing is different and what is behind the scene is different. Of course, they said that there can be savings from defense and savings from the cost cutting on the government staff, but other resigning the contracts, etc., would be extremely difficult. And the legal cost to the government could be far exceeding than the savings which they're talking about. So, I'm sure the government, Mr. Trump and his advisors and various other ministers knows about these things. So we do not know what is behind the scene. And as I mentioned, it is extremely difficult for any economy to get isolated in the short term. And we know globalization has happened over many decades after a Second World War. It was not, it did not happen in, 1, 2, 3, 5 years. So from this perspective, as Rajesh mentioned, we need to have calm and wait for the more clarity to emerge. But in terms of investing, Rajesh has already suggested the way forward.
Yeah. Another, just now you're there, so there is another question. What is your point of view on tensions between countries? Taiwan, China, USA issue, USA, Iran issue, which seem to be sitting on a power cake of the sort.
Well, let me clarify. I'm not geopolitical experts, but whatever little understanding I have, basis the past moves by the various governments, these are again negotiating tactics. If you look at, Mr. Trump said, Ukraine, we will stop giving security to Ukraine. But at what? He said he wanted rare earths. Now, rare earths are very, very critical for now manufacturing the electronics, for their space technology and so on, right? Similarly, Greenland, he said, I will annex the Greenland again, which has got, the very large deposits of rare minerals, So I think all these moves are having the economic agenda behind these statements. So that clearly appears. So I think it's while short term it looks very, very shaky and dangerous, but all seems to have economic agenda behind this. And from that perspective, I think we need to observe calm and wait for the clarity.
Thanks, John, sir. The next question from the investor, I think there is around 11% cash in my PMS. What is your advice on the top up? Are we waiting for some signal or dust to settle?
Well, I think every day is a new day in this kind of uncertain environment, and we do our best to make sure that protect capital, create wealth. So we do the timing as best as possible. And I generally tell all my investors, please you do not time the market. You leave it to us, and we do what is our best possible from our side. So you don't wait and don't look at that investor level, because we keep changing our stock. So a stock, for example, which I bought yesterday, taking advantage of 20% decline in market, then suppose somebody wanted to do top up, but if you're not, then surely that will not come in your portfolio if you are fully invested, or the weightage might be different. So please don't time the market from your side. We also are not timing the market, but we are timing the sectors and the stocks. We are timing the business cycles. We are not timing the market per se, correct? And that's the best thing to do, keeping in mind the long-term time horizon.
Okay.
Yeah, Sandeep, let me add one more point regarding the negotiating tactics by various countries. While China is talking about the retaliatory tariffs, equivalent to what US has imposed. If you look at the currency, yuan, renminbi, it is depreciated almost 4% in last 4 months. The Central Bank of China has benchmark of 7.2 for $1. And yesterday, or rather today, India time, it has crossed 7.2. And if you look at the spot has now crossed 7.33, which is, and if you look at the technical chart, then if it goes up from here, so this can depreciate significantly. China has used these tactics in 2018 also, so now there are various experts are talking about the China can devalue the currency. In fact, one of the largest banks in US, Wells Fargo, their strategist is saying that there's 75% probability of Chinese currency getting depreciated by 15%, So the countries have that tool also in their hand, and it is not easy to unilaterally just simply impose tariff and say that, you have to, abide by what I'm saying, So this is also a possibility, and hence the turmoil can continue for some more time, but one should keep these things in mind. And as it happened in 2017-18, then just settle down.
Okay. Sir. Next question. Sir, your view on real estate sector. Are there signs of slowdown?
I think so. Real estate, see, I think every asset class is a cycles, and I believe that real estate cycle, in terms of the valuations, we are seeing kind of a near to the peak valuations. The cycle has started from December 2020 to 21, 22, 20, 24. So I think last 4 years have been great years from the both fundamental perspective as well as a valuation perspective. From here on, I would expect that it will not crash. The real estate, the real economy, I'm saying, that is not going to crash. But supply is becoming higher than demand, and that will put some cap on the pricing of the real estate. You will also probably, we believe that the velocity of it, the churn of that in terms of the number of days it was taking for a project to get it sold off will also be longer compared to what we have seen in last 12, 18, 24 months. So as a sector, we are not so positive on the real estate sector from current levels. We believe that sector may go through the time correction. As a real estate prices may not come down, but maybe the time correction can be much longer. So one needs to do real bottom picking within the sector to make sure that you are at the right stock and at the right valuations.
Okay, thanks, Raj. Next question. What will be the impact on Indian electronics manufacturing as a lot of global players started manufacturing in India? Will it grow and to what extent?
I think the EMS, the electronic manufacturing, is we are at the best of the inflection point. As I said, India market share is less than 5%. We have a huge opportunity. If you look at the tariffs, India is much lower compared to China and compared to Vietnam. And therefore, this is a real good opportunity. The Indian government is also supporting these incentives through PLI incentives and all the other incentives to improve the domestic manufacturing. The entire value chain, government is, earlier there was only one component. Now the government is focusing on further backward integration to make sure the entire component system is also made in India. So we are very positive on EMS space in general. And I think this space is going to do extremely well with the new US tariffs. We have a further scope to improve the market share on the global map. So we are bullish on EMS as a theme.
Okay, thanks. Another question. How we navigating in the IT sectors allocation after Trump tariffs, means considering the Trump tariffs? Are we making any changes?
Yeah, we have already reduced, as I've explained, we have already reduced our exposure in our IOP and our budding based. We are underweight on IT sector compared to the benchmarks. Of course, on the valuation side, free cash flow yield is becoming now attractive. So probably stocks may not go down significantly, but we are waiting for dust to settle because if there is a significant high tariff, then there might be some slowdown in US economy. And slowdown in US economy is not good news for Indian IT sector. So wait and watch. Right now, we are not that bullish on the sector generally. Of course, there are stock specific, we might have different views, but as a sector, we are a little bit cautious and we want dust to get settled.
Okay, thanks. The other question, is it good to invest now? Should we consider adding in different positions or one shot, mention staggered or lump sum if we have extra funds?
I think in IOP, we are recommending the lump sum investments. I know markets are volatile and there is uncertainty, but generally in uncertain times, you make good returns. Of course, you need to have a longer term time horizon. So if you have mind that if I invest today, what if the market goes down tomorrow by 5%? You can't predict how much market can go down. So depending on your own risk reward metrics, you need to check what are your appetite to absorb the volatility. And that's something very, very important. So lump sum is also fine in IOP. In budding based, we are still recommending STP spread over 2-3 months from the mid and small cap perspective.
What's your view on the rate cut decision by RBI? It's difficult. In fact, on what will be the recommendation to the clients who invested at 25,000 Nifty? On specific, your view on Trent and Tata Motors. I don't think we can take this stock specific.
Yeah. So basically, coming to one, let's take one by one question. So with the the recent tariffs and all that stuff, I think if you look at the last particularly 45-60 days, RBI has been supporting the best of the support you have seen from RBI. Number of steps RBI has taken to improve the liquidity in the system, and I believe that the inflation is under control. The food inflation is also under control. So there is a good room for RBI to do the rate cuts. How much rate cut and by when? I would not like to speculate, but I think there is a good possibility of rate cut by RBI over next 3, 6, 9, 12 months. Your second question, what was the second question, Sandeep?
Your specific views on Trent and Tata Motors.
Oh, that was third question. What is second question?
What will be the recommendation to the clients who already invested at Nifty 25,000 level?
So irrespective at which level you have invested of Nifty, if you have a 3 to 4 to 5 years view, as I said, we believe that India is at a right point. There is a huge opportunity in front of us. And as a portfolio manager, anyway, we are dynamic, we are agile, we are taking the right sectoral views and the right companies' views. So if you have a 3 to 4 year, 5 years view, we are bullish on India. Coming to your last question, we have a zero exposure to Tata Motors from last 5 years. As far as trend goes, we continue to like trend. We have identified this company about 4.5 years back. It has been the biggest multi-bagger for our portfolio clients. We kept trimming our exposure because weightage kept going up, but we continue to own trend in our portfolio. The trend has recently reported about 25% plus growth, which by no means is a small number, keeping in mind the entire economy, which is going through the slowdown. Is one of the few companies which is growing healthy double digit in last 3.5, 4 years. It has grown 30% plus. And even in the current year, as per the recent press release, they've delivered 27% plus growth. So great performance by trend. And we continue to hold this company in our portfolio. But of course, we have reduced our weightage because weightage kept going up because of the stock price appreciation.
Thanks, Rajesh. We come to the end of question queue today. And participant requesting everybody, if you have any questions after the webinar as well, please reach out to us, reach out to our local sales team at Delhi, Mumbai, and wherever. We are also there. Thanks, Rajesh.
Thank you, friends, for hearing us patiently. We will give the YouTube link very shortly, and we will upload on our website and we'll share with you all guys. And do let us know if you have any queries. Thank you once again. Goodbye.
Thank you.